Every bull market has a fuel. Sometimes it's earnings, sometimes it's liquidity, and sometimes it's borrowed money. It is quietly building beneath the large street. Most investors don't even know it exists. As of 3rd June 2026, investors have borrowed roughly rupees 1.28 trillion through margin trading facility or MTF to buy stocks. And what's remarkable isn't just the size of that number, it's how quickly it has grown. Just 6 years ago, India's MTF book stood at only around rupees 31.6 billion. Today, it is nearly rupees 1.28 trillion. That's more than a 40-fold increase. Now, leverage isn't new. Every major stock market uses borrowed money. And high leverage alone doesn't tell us whether markets will rise or fall. But when borrowing starts growing this quickly, it naturally raises a question. Have we seen something similar before? Fortunately, we have. To answer that question, let's look at the world's largest stock market, the United States, and what happened during the two of its biggest leverage cycles. Before we compare India with the US, let's understand what MTF actually means. Imagine you have rupees 2,50,000 rupees. Normally, you can buy rupees 2,50,000 worth of shares. But under the MTF, a broker may allow you to buy shares worth rupees 1 million or 10 lakh rupees. You contribute rupees 2,50,000, but the broker funds the remaining 7,50,000. If the stock rises, your gains become larger, but if the stock falls, losses also get magnified. That's the basic idea behind leverage. And Indian investors are using more of it than ever before. But the real story isn't just the size, it's the speed. Since 2020, the MTF book has expanded more than 40 times. Few segments of India's financial markets have grown this quickly. So what usually happens when the leverage starts expanding at this pace? History offers some clues. To understand why investors track leverage closely, it helps to look at history. And for that, we'll compare India and the United States during one of the most dramatic periods in modern market history, the run-up to the global financial crisis of 2008. The United States is the world's largest and most mature equity market. While every market is different, its long history of leverage cycles provides a useful reference point for understanding how borrowing behaves during both bull markets and periods of stress. But the leverage boom wasn't limited to America. India was experiencing one too. According to the historical data, India's MTF book stood at roughly rupees 309 million in 2005. Over the next 3 years, as investors' participation increased and stock prices rallied sharply, the number climbed to around rupees 2.24 billion by April 2008. That's more than a seven-fold increase in just 3 years. The United States witnessed a similar trend. US margin debt stood at roughly $188 billion in July 2004. By July 2007, it had surged to more than 416 billion, a rise of over 120%. In both countries, investors were increasingly using borrowed money to participate in rising markets. Then came the global financial crisis. Stock markets around the world corrected sharply as the financial system came under the pressure. It's important to understand what happened next. Leverage did not cause the crisis, but once market starts falling, leverage amplified the impact. As prices declined, collateral values fell. Investors faced margin calls, some positions had to be sold, and that added further pressure on stock prices. The same pattern had appeared earlier during the dot-com bubble. US margin debt climbed from roughly $105 billion in 1997 to nearly $300 billion by March 2000, reaching a record high almost exactly when the technology bubble peaked. The Nasdaq later lost nearly 78% of its value. Today, leverage is once again climbing. US margin debt has crossed $1.2 trillion for the first time in the history. And in India, the MTF book has expanded from roughly 31.6 rupees billion in 2020 to nearly 1.28 trillion today. That doesn't mean history will repeat itself, but it does show that rapid increases in leverage are not unique to one market or one cycle. They have appeared repeatedly across different countries, different decades, and very different market environments. At first glance, India's leverage boom may look similar, but there are some important differences. Historically, leverage tends to rise during powerful bull markets. Investors borrow more because stock prices keep moving higher. India's MTF book, however, has continued expanding even as the broader market has spent long period consolidating. Another difference lies in market structure. In the recent post by Zerodha's co-founder Nitin Kamath highlighted that a significant portion of industry's MTF exposure is concentrated in stocks outside the FNO segment. These stocks generally have lower liquidity compared to large cap names. That matters because leverage depends on liquidity. As long as buyers and sellers remain active, leveraged positions can usually be managed smoothly. But when liquidity dries up, things can change quickly. Large cap stocks often have enough trading volume to absorb selling pressure. Smaller stocks may not. And that's one reason why market participants have started paying closer attention to the rapid growth of MTF exposure. One of the biggest misconceptions in financial market is that leverage itself is dangerous. History doesn't support that view. Leverage exists in every major market. Investors use it, institutions use it, even some of the world's largest funds use it. The most important question is where that leverage sits and how quickly it grows. Because leverage tends to remain invisible when the markets are rising, collateral values stay strong, investors remain confident, borrowing keeps expanding. The real test comes when liquidity starts disappearing. That's when leverage becomes visible. And that's the common thread connecting nearly every major leverage cycle in market history. India's MTF book has grown from around 31.6 billion rupees in 2020 to nearly 1.28 trillion in June 26. At the same time, US margin debt has climbed beyond $1.2 trillion. Neither number predicts a market crash. Neither number guarantees a trouble. But both tell us something important. Investors across the world are relying on borrowed money more heavily than ever before. And whenever leverage starts growing at record speed, it becomes a number worth watching. Because history may not repeat itself, but it often leaves clues. Please follow Equitymaster for more such updates. Thank you.